Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow, in which we invest additional money on the first trading day of every week. They're the Dividend-Growth stock portfolio, which was started in 2022 and now has an annual return of 19.12%, and our high yield stock portfolio, which has an annual return of 20.93% per year and is beating the S&P 500. The high yield portfolio was started in 2023. On the chart, I've also included their benchmarks for comparison. I recently started putting the list of dividend growth stocks we buy each Monday on a Substack newsletter. You can sign up for the newsletter for free. You can find the link to the Substack newsletter in the video description. Again, it's totally for free to sign up for. I'm trying out Substack to see what it's like as a platform, and since I'm brand new to Substack, the newsletter is nothing fancy right now, but we should get better as we learn the platform. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio, that my accounting students and I started last year as outlined in red, and now has an annualized return of 20.23% as tech stocks took a huge beating when the tariffs were announced and have had a huge comeback since the tariffs were lowered and postponed. The volatility of the tech stock portfolio has been crazy and is only for diehard tech investors. It's one of the newest portfolios, and because it's 100% invested in tech stocks, it's our most volatile portfolio. Like our dividend stock portfolios, the tech stock portfolio is a real-world investment portfolio where I make additional investments on the first trading day of each week. So in effect, all three portfolios are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. Next week, we'll also talk about our Wide-Moat and Capital Light portfolios, which are also beating the S&P 500. As a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to read more about them if you like less frequent trading. Now here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies, both the high yield and the dividend growth, as well as the high dividend blue chip stock portfolio, are my personal favorites since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular, so I put it on Substack for free as an experiment to see if I like the Substack platform. So far, Substack is easy to use and is turning out to be more fun than I expected. You can find the list of dividend growth stocks we're buying on the first trading day of each week, either on Substack or, if you can afford it, on my website. Now, you can find most of the strategies on my website, beatthestockmarket.com, but if you can't afford it, each week for free I've been detailing the dividend stocks we've been buying in a YouTube video, and then I feature the tech stock portfolio, Wide-Moat strategy and Capital Light strategy in the next week's video. So far, lately, I've been rotating between dividend strategies and then tech, Wide-Moat, and Capital Light. Now, I found this week that Substack has a notes feature, which are free for anyone to read. And last week, I posted two notes, one of which included the list of Capital Light stocks we bought for our Capital Light strategy. If you're interested in that, sign up for free on Substack and feel free to leave me a comment to let me know to post either the list of Capital Light stocks we buy each week or the Wide-Moat stocks we also buy each week as part of our Wide-Moat strategy. I don't want to make a routine of posting them each week if there is not much interest in them. So if you are interested in them, just leave me a note on or leave me a comment, however it works, on Substack. Remember, I'm new on Substack and I'm still learning it. So now in this green box, note that I've added a note that those three strategies are newer, and therefore the average investment has been held for less than a year. This means their annualized return will fluctuate a lot until the holding period eventually grows. For example, the Capital Light strategy is by far the newest, as it was started in February of this year. As you can see on this bottom table, the average investment in that strategy, the Capital Light strategy, has only been held for 53.4 days. And has a return of 10.14% over those 53.14 days. Now, the annualized return of 93.64% should be taken with a grain of salt. All it means is if a stock's price increases 10.14% every 53.4 days, then you would get a 93.64% annual return. Now, will it continue to do that? No, but I'm hoping it can continue to beat the S&P 500. So just be aware that the annual returns of these newer portfolios in the green box can and will probably jump up and down a lot, especially if there's more tariff announcements. So now this slide is showing the portfolio value over time for our original portfolio, our dividend growth stock portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $3,000 after 176 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks, so we are buying fractional shares. Each week we re-rate the stock, so the list of top stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now, the tan line on this chart shows what the portfolio value would have been if we'd instead just put the money into a savings account. Now, in our first year, 2022, stocks and bonds did not do well at all. And as you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. And again, recently it's taken off again after the announcement that the tariffs will be lowered and postponed. Now, I'll update our tech stock portfolio in next week's video, which we started late of April of 2024 and has been the best performing portfolio over that time. Before we get into which stocks we bought last week, a lot of people have been asking what my favorite books about investing are. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis of 2 of the 3 stock screens I publish on my website, beatthestockmarket.com. They are the trending value stock screen and the consumer staple stock screen. I update the stock screens monthly. Now, so what's a stock screen? It's a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do for further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price-to-earnings ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs, or if you're a numbers geek like me, you'll probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screens on your own. It's a much shorter book than What Works on Wall Street. I'll try to put the links to the 2 books in the description of the video. Check your local library, see if you can save some money. Check out the books for free first. Now, a very popular exchange-traded fund, ETF, that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our dividend growth classroom stock portfolio's return is 19.12%. If we'd instead invested the same exact amounts into SCHD on the same exact days, the portfolio's return would only be 5.57% per year. Our high-yield portfolio is also outperforming SCHD. Now, obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our 2 dividend-paying classroom stock portfolios, as well as some of the other strategies, too, that we've been trying. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks I consider to be value traps, and that's not a good thing. This slide shows our best performing stocks for our original portfolio, the dividend growth stock portfolio, based on when they were initially purchased. Stocks in yellow, like Evercore, have been sold. Broadcom is in first place with a 311.5% return. Evercore, an investment bank, is in second place with a 252.9% total return. It's been sold. And the fastest risers that are still in the portfolio are Bank of New York Mellon, which has more than doubled in 19 months, Goldman Sachs, which is up over 107% in 25 months, and Portoflio Education up 94% in 21 months. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's talk about the strategy column, specifically the strategy called dividend growth stocks. 90% or so of our investments made in this portfolio were made in these stocks, which means they're high quality stocks with a great track record of increasing their dividend payouts to investors. The other 9 or 10% of the investments so far have been made in usually smaller, under the radar dividend paying companies. These under the radar dividend paying stocks tend to be riskier because they're usually smaller companies, but studies have shown that they historically beat the market averages by a significant amount. These companies are ones that have recently started paying a dividend. Now, if you're wondering which of the strategies has performed better, the dividend growth portfolio has outperformed the under the radar dividend payers by a lot. So keep that in mind so far. This slide shows our best performing dividend growth stock portfolio this week. It does not include dividends. The best performers last week were Nvidia up 16%, Build-A-Bear Workshop up 13.7%, KLA Corp up 12.8%. Then we got Monolithic Power, Lam Research, Microchip, Taiwan Semi, and Broadcom, amongst others. And this slide shows our best performing dividend stocks last week for our high yield stock portfolio, which is far fewer holdings than our dividend growth portfolio. The best performers last week were Microchip at 10.6, Goldman Sachs, Morgan Stanley, PNC Financial, US Bank Corp, Darden Restaurants, Nextera, and M&T Bank Corp. And then just for fun, this slide shows our best performing stocks in our tech stock portfolio last week. The best performers were Shopify, up almost 21%, Nvidia again, KLA, Lam Research, Arista Networks, NXP Semi, Taiwan Semi, Broadcom, and Analog Devices. So here's the usual disclaimer. This presentation is for informational purposes only. It's not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So let's talk about the dividend growth stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and also Substack. Then we purchased the top 10 stocks that are not in yellow. So the one in yellow, Microsoft, that Microsoft is 4% or more of the portfolio. So I don't, once a stock hits that 4% or higher allocation, I don't invest more in it because we want to have a diversified portfolio. And remember, we use many criteria to filter stocks. And if a stock is hovering near a required level, they can make the list one week and then drop off the list based on a small movement. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. Now, for consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means the stock suddenly does not make the list at all. And this happened to Sony last week. I wrote a note on Substack that you can go read about Sony. So Sony was number one on this list until we got to the filtering criteria where we got to filter out stocks that are not forecast to increase their earnings by 5% or more. So Sony came in at 4%, so they just barely missed making this list. Now that doesn't mean we're going to sell Sony. It just does not make the list of stocks to buy that week. So as I mentioned, each week we buy 10 stocks in this portfolio, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And this table in this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends. And our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 9 or 10% so far have been invested in those usually smaller under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. Risk is the first quality component, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data, because as an accounting professor, that's what we do a lot, to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not usually the way it works. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. Now, this is also a new color code I added last week. The orange means the stock is new to the portfolio. So this is the initial purchase of Lowe's companies for the portfolio. I really like the Lowe's/Home Depot business model. It's one of those are some of those companies that you can just buy and hold forever. Now let's talk about our quality rating. One of the components is moats, a measure of competitive advantages. One advantage of companies with the best moats is if they pay dividends, they're more likely to increase dividends even during an economic shock when compared to companies with no moat. On this slide, Morningstar shows there are three categories for moats. On top, we have the companies with the wide moats, which are the best. And then we got the narrow moats, which is in the middle, and the no moat, which is the worst. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were able to raise their dividends despite many companies being in financial trouble. Only 18% or so cut their dividends. Now for companies with no moat, which is on the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality rankings for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers the 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year. Here's a look at the 10 stocks that make up the largest portion of the dividend growth stock portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Now, if you want to see if you can stick with a volatile portfolio, just follow our tech stock portfolio. For a while there, it was producing losses, and now, because in the last 2 weeks, the tech stocks have surged because of the recent tariff announcements, and now the returns are really good again. But if you didn't know the ups and downs of it, you might not be prepared for the psychology of it. So our portfolio holdings in the dividend growth portfolio are 105, with 89% of the weighting being in the high quality dividend growers and 11% of the portfolio's weighting being in the under the radar dividend payers. We usually make far more additional investments into the dividend growers than the under the radar dividend payers. So far, around 100 to 105 stocks seems to be the natural limit for the portfolio, as there are only so many quality dividend paying companies that are trading at a discount. Now, I did sell 2 stocks last week from the dividend growth portfolio. You can see that on Substack or beatthestockmarket.com. I'm doing a little bit of spring cleaning, and we'll probably sell at least one more upcoming on this Monday. So now this holding number, 105, might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and does not take that much time. The thing that took a long time consuming was creating the spreadsheet. It took 2 years to create. Now, some have asked if this spreadsheet is available. No, it'd be too difficult to have you set up your data source to match our data source, etc. And you'd also need training on how to use it. So at this point, this is not available to use. You'd have to be an Excel expert to figure out how to use it. Now let's talk about our high yield dividend paying stock portfolio. I've had several older students that are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields, like 3 to 4 to 5%, higher than the ones in our dividend growth stock portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts in a separate portfolio. The portfolio as a whole has an annual return so far of 20.93%. And like all the stocks recently, it has bounced back big time. Currently, the high yield portfolio's dividend yield, if you bought all the stocks today, would be 4.3%. Compared to our dividend growth stock portfolio, the companies in this portfolio likely will not grow their dividends as fast. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks at a high price and reinvest into better bargains, pushing the portfolio's yield based on the amount we've invested to 4.86%. Now, 2 strategies are being implemented in this portfolio, as you see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1, in an attempt to try to get the best of both worlds, that being high yield and dividend growth. So which one has been better so far? Strategy 2 is the better performer so far. The average investment in Strategy 2 has provided a total return of 14.63% and has been held for an average of 227.3 days so far, and that's an annualized return using Excel's rate function of 24.54%. Now let's talk about the high yield dividend paying stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased these 8 stocks. One thing that's different about this higher yield strategy versus our dividend growth strategy in the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. So strategy 1, as I mentioned before, emphasizes a high dividend yield over dividend growth. It's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. So the stocks that we bought last week with implementing Strategy 1 are Comcast, Merck, Novo Nordisk, and EOG Resources. And for Strategy 2, and you can see there's some overlap, Comcast, Merck, EOG Resources, and PNC Financial. And here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend yields. All right, that's it for this week. In the comments, let me know if you have any questions, and also let me know what portfolios or investment strategies you'd like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as my website, beatthestockmarket.com. I guess I should add Substack on here too, LinkedIn, and Twitter. I'll talk to you next week with another portfolio update. See ya!